Mutual funds and hedge funds are two things we hear about all the time, and with the exception of a few basic details, we don't really know much about them at the same time, and we don't know how they differ. You can probably ask anybody on the street and they'll tell you for the most part, mutual funds and hedge funds are a bunch of guys in suits that invest in the stock market and all that other jargon and make a lot of money doing so. And that is for the most part true, but there is a big difference between the two, and if you're a participant in the financial markets, it's probably best that you know how these two entities differentiate. First, right off the bat, both mutual funds and hedge funds are considered institutional investments. What that means, simply put, is these guys are the big money, whereas average day regular Joes are considered retail investors. Institutional investors usually have a lot more money to invest, they're a lot more sophisticated in their investment, and people often use that as a selling point when they're trying to buy or sell a security. Me personally, I'm a lot more calm and sleep better at night when I know that institutional investors have their money in the same assets that I invest in. So both hedge funds and mutual funds directly invest in financial assets aiming for growth and performance. Both are run by a team with a hierarchy starting from the top guys, which are the fund managers, and eventually trickling down to senior associates, junior associates, analysts, etc. The structure of both hedge funds and mutual funds is that they pool capital from investors, meaning they take their money and they invest it for them. And although it sounds like a nice idea, they're not doing this out of the goodness of their hearts. They're doing it with the aim to make a profit and to take a cut of those profits as a fee for their services. However, there are a lot more differences than similarities. Mutual funds are highly regulated entities. The reason they are much more regulated and restricted is because they invest a lot of the public's money. If you go to any one of your banks and you have a decent amount of money, you'll probably get a recommendation if you deal with a teller on how you should invest your money with a mutual fund. It's usually one of the funds they offer, whereas hedge funds have a lot fewer investors and they don't generally hold the public's money. Hedge funds are often very strict on who they get to invest with them. They usually accept on the concept of what's called a sophisticated investor. Now, a sophisticated investor doesn't really have to be sophisticated at all. A sophisticated investor just means you have a personal income of $200K a year, or you and your spouse have a dual income of $300K a year. And along with the fact that they are more strict in who they have invested with them, they're a lot more discreet on their investment strategy and philosophy as well. If you want to find information about a mutual fund, their information is often very public. They tell you about their philosophy. With some time, they'll tell you exactly what they're invested in, where they've made the money, etc. Many people hold their money with a hedge fund and have no idea whatsoever as to where their money is at any given point in time. Hedge funds do not disclose their positions until many ways down the road. They do this because it is sensitive information, and the advantage for them is to act first and find opportunity. It is no longer acting first and finding opportunity if everyone knows what you're doing. Hedge funds are exceptionally more sophisticated in their investment strategies. This means they engage in all different types of investment strategies. Most are very advanced. Now I can make a whole video or multiple videos talking about the different types of strategies hedge funds invest in, but that's not the point of this video. But just understand that their investment strategies include selling short, buying distressed securities, buying mezzanine debt, using options and derivatives, synthetic assets, micro-cap super volatile stocks. These are just to name a few. They also take up very concentrated positions, meaning they do not hesitate to allocate high portions of the fund's capital to one specific position. Mutual funds, on the other hand, are often long equity funds. What this really means is they buy stocks simply with the aim of them going up. They're very regulated in what else they can do. They don't engage much in selling short and all the other various types of these sophisticated investments because these usually tend to be very risky and much more volatile. The payoff is much more rewarding as well, keep in mind. The standard rule, and this may vary country to country and region to region, is that a mutual fund cannot invest more than 5% of the total fund's capital to any one specific position. So let's say, for example, you have a mutual fund worth $100,000. That means you cannot invest more than $5,000 into any one stock. Now this can kind of be of a bad situation. Imagine if you found the opportunity of a lifetime in the stock market. You know with a great amount of certainty that this stock is worth more than what it's selling in the current market price. If you were a mutual fund manager, you'd only be able to invest 5% of the fund's capital, and therefore your return might not even be that great. However, if you're a hedge fund, you can invest astronomically more amount of your fund's capital, and you probably will. Because you're looking for that raw and high level of profit that's associated with all these movies that you see in Hollywood about Wall Street. The kind of sexy, super sophisticated, super volatile, make $1 million in a second kind of investing. Mutual funds are very much not in that category. And because mutual fund strategy is often just a long equity fund, they're benchmarked much more heavily toward market indexes. And the reason for this is because the quantity of investors they have in their funds is so astronomically high. We're literally talking about millions of people in many cases. They have to kind of beat a specific index that they are compare it against. So for example, if a mutual fund is invested in North American stocks, they're probably going to be benchmarked against the S&P 500. And this makes sense because the investments that they're making are within these indexes. So beating the market is a huge plague on mutual funds, because if they can't beat the market, then there's no reason for an investor to give their money and pay the expense ratios associated with investing in them. The investor has a much larger incentive to just buy the index fund and buy the so-called market. You buy an ETF or a broad market index fund whose performance is made to reflect the market. Because hedge funds don't really invest in that way, they're not really benchmarked against the S&P 500 or any other big index. And for the most part, hedge funds are not looking at their performance on a year-to-year basis. Like I said, because they engage in such highly sophisticated strategies sometimes, the payoff when they find opportunity is not going to be the next day. It could take years to unravel. One example of this, if you read the book or watched the movie, is The Big Short. Michael Burry's Scion Capital was a hedge fund, and when he found opportunity in the housing market, he essentially allocated all the money towards this investment premise. Now, was this smart? Well, obviously it's very risky, because if this doesn't turn out to be profitable, you lose everything. But in the case of The Big Short, and as I said earlier, it took years to unravel. And those are just some key and distinct differences and similarities between hedge funds and mutual funds. If you have any feedback or comments, feel free to shoot down below. I want to thank you guys so much for listening and hope you guys have a nice day. Take care.